Good day, everyone. Good day, everyone.
Good day to
I
everybody
hope
around
you're
the
having a
world.
great weekend. I'm Irfan Khan, private investor and Joe's business partner. And Joseph here sitting with us is a hedge fund manager with more than 25 years of experience on Wall Street.
Indeed,
And
you can tell by the gray hair. It's you haven't gotten there yet.
yeah, I haven't gotten there yet. I hope to get there in good time. I'm not in a hurry, but definitely happy to be here on this weekly appointment with you. This is our first episode,
That's it,
and
indeed.
the objective of this is to provide all of you listeners and watchers with a market recap and outlook of the markets.
Equity markets specifically. That's my
Very good.
forte. I've been as you said, for those who don't know me, I'm regarded as the grandfather of sustainable investing, having launched the very first sustainability focused hedge fund on Wall Street. I'm an equity guy, so we're going to be focusing on equities and macro in general. But if you're going to tune in thinking that we're going to speak about the fixed income market, this is not the channel for you.
All right, so we're already cut it down a little bit.
Yeah.
Okay, Joe. Why don't we get right into it? What is your quick summary of how the market performed in the past week in general? Maybe you can also be more specific, where your attention lies, Wall Street versus other markets as well.
Yeah, I mean, okay, so for the past week, the market, especially the tech sector, was trying to consolidate around this, drawdown that it's had since October 8th. And it's been quite brutal, a lot of bloodbath. Many of the stocks that I owned, I mean, I was up for the year 40+% at the beginning of October with my portfolio. And I ended up going negative in a month. I mean, that's how bad it was. But I have a Telegram group that I host where I invite people to join and tell them what I'm doing with my money. And I had actually not predicted this. I predicted many corrections in the past, but I did say that the market was going to consolidate around the 50-day moving average on the S&P and the composite. It did. It did respect some support, and I think that the market is ready to move back towards more acceptable levels. The tech sector specifically. So while the healthcare industry or the healthcare sector has done a lot better than most other sectors. In fact, there's there's been a direct decorrelation for the past month between healthcare and tech. It's incredible how that flight to safety took place very swiftly, actually. So anyway, I think the tech sell-off was overdone. People talk about AI being in a bubble. I don't see it yet. I mean, if it is a bubble, it's too early to start speculating on which are going to be the winners or the losers of the space. I've made this analogy in the past with the dot-com bubble, where people were buying anything that had a dot-com behind the name because they thought that internet and e-commerce was going to be the future. Many companies like egghead.com or toys.com, whatever, they all went out of business, but Amazon is still around, Google is still around, and many other names back then are still around today, and they're really big companies. But the difference here is that with the AI revolution, we have governments competing for leadership in this sector. Back then, aside having a website, governments had nothing to do with the dot-com revolution. Here we have governments heavily involved, capital, and so it's a different animal altogether. And here you have also real names putting money to work in the AI space, not companies that had no revenues when we're going public. Oh yeah, but we're just going to go public and make a lot of money, but you have no earnings. So here we have big companies that are pushing, and the tide is lifting some names. Some of the names I have in a portfolio, like Applied Digital, for example, got beat up because obviously being a hyperscaler of data centers, it does a lot of work with crypto, and we saw what happened with crypto, and Bitcoin got destroyed from 126,000 down to 80 something thousand in last month. So obviously those data centers, chip makers, AI maker, those have been affected mainly by the fact that there was a crypto correction, a massive one too. Yeah.
Okay. Okay. Well, that's an interesting story, and sort of, and it's important to understand where some of these things are correlated, right? Where they might have some kind of correlation. So you just mentioned, cryptocurrencies with AI, both of them tanking in the last month, at rates we haven't seen in ages. I mean, would you say this is almost like close to being some kind of an effect that would almost remind you of some kind of black swan effect? A black swan event?
No, I mean, this reminds me of the sell-off that we had in between July and August of 2024. There was massive
Mhm.
panic. People were buying Nvidia a buck 50, 150, and then it went down to 85, 90, whatever that number was. People were really concerned back then, and then look at 2 months later, we're at new highs. I think that's what's happening now. There's been a flush out. Those who didn't belong in the market and got kicked out, they're out, and that's the end of the story. The market is going to come back up. So I mean, we have gotten beat up so bad on the tech side that it was inevitable. Some of these valuations looked extremely acceptable just last week. I'm not saying that for everybody, and for the companies that are not profitable, not yet, but it was a flush out, and I think the market is ready to make new highs. Actually, I think that we're gonna do very well in December going into January. I mean, 75% of times the stock market has performed well in December. We have a 90% chance of a Santa Claus rally. That's between like the last week of December, first week of January. I think we're going to see markets come up. And the other thing is that we're going to see fourth quarter earnings next month. I'm sorry, no, yeah, well, not next month because it's still November 30th today, but in January, we're going to start seeing, end of January, we're going to start seeing third quarter earnings. And I think they're going to be, there's going to be surprise on the upside. I really believe that all the effort that has been put into this sector in the last couple of years and so forth. I haven't seen a slowdown in earnings, and actually, the last earnings season, which is third quarter, the upside surprise upside surprises were plentiful.
So it looks like this could actually offer an opportunity, a timely opportunity for those who want to get into the market now
Cautiously.
to buy some of these stocks, which could offer, good
Yeah.
amount of upside, right?
Yeah, absolutely. But you have to pick and choose your stocks. You can't just buy anything. And
Of course.
look at companies that have good prospects for earnings, or companies that have momentum. And there's something like, and obviously if they look at good management, but the core issue here is trying to pinpoint those companies that have a chance of hyper growth moving forward in the tech sector specifically. I'm just concentrating on the tech sector because it's the one that's gotten beat up in the last month or so. But and so if you're picking stocks in the tech sector, you want to play AI, buy good companies. Don't buy companies that shady, don't know where they come from. There were some reverse merger or some special purpose vehicle brought public, and just look for companies that are pure plays and that are pushing and they're growing, and they're growing on their earnings, their revenues and cash flow. So we want to pick companies that have that are focused. The management is focused on the task at hand.
So basically, our call to action is essentially do your homework before you venture into picking any of these stocks.
Absolutely, always.
It's always good to carry your own
You don't want to
carry
throw a
out
dart at the
your
wall.
diligence.
You don't want to throw a dart at the wall and say, okay, yeah, this is a stock I'm buying now.
Absolutely. That's a great analogy.
And the other one thing is, I always tend to stay away from companies that everybody owns. You know that, right? Because you see my portfolio. I have never owned NVIDIA once. But I do own Supermicro, for example, which uses NVIDIA's chips for their AI servers, and not only, but I will go with, I don't want to I don't want to be exposed to a company that everybody owns, because then you have valuation distortions. I mean, the first company, first stock to sell off is going to be the one that is most widely held, right?
Yeah, yeah. Well, that's a good point. Yeah, that's not something that we often hear about, So that's definitely something which is worth reflecting on.
Well, I come from,
So
I was a banker for Enron back in the days when I was at Deutsche Bank. I was an investment banker. And I saw that. I mean, Enron was the number one stock on Wall Street for a few years. I mean, and then everybody realized, that was just a bunch of crap. But and somebody has made this analogy, or at least comparison between like Nvidia and Enron, which is completely stupid. But Enron was committing fraud and defrauding investors by hiding losses in companies that were in the Caribbeans and whatnot. But I remember that. So even WorldCom, Global Crossing. I mean, lots of big companies that everybody owned. So try to stay away, unless you're doing it for income purposes. You want to buy a Johnson and Johnson or a Philip Morris.
you mean for dividends?
Right, but if you're looking for growth, stay away from the stocks that everybody owns, because while it might work in your favor in the case of Amazon or Microsoft or Facebook, but when it comes to a company that it's overperforming the average performance of its sector, that to me it's a red flag if it lasts too long.
Okay. Well, thanks for that. So we've talked about tech stocks because they were under the spotlight for what we just talked about. But it wasn't all bad in the past few weeks, was it? I mean, there's the healthcare sector that
Did
did pretty
well.
well, right?
Yeah, the healthcare sector did well. Other sectors have done okay. Consumer staples. So one thing that I still haven't gotten around to understanding is why the consumer staples and utilities have not done as well as the healthcare sector, because these are just like healthcare, they're defensive, but healthcare seemed to have gotten a nice kick in the last couple of months. And perhaps there's less direct hit or impact on tariffs. The U.S. tariffs, the genius policy from the Trump administration. But the other thing is, which has put people on economists and fund managers like me a bit on eggshell, because here we are thinking, inflation is going to creep up again. It did, but not as much as I was expecting, and we don't know what's going to happen in the coming months. But we also have a ruling from the Supreme Court in the United States, which is going to whereby they're going to deem whether they were legal or not legal. So that's one thing. But and inflation, everybody has this common misconception that, okay, inflation comes down from 3 to 2, that prices are going to go down. No, that's not how it works. When inflation comes down, the only difference is that the rate of increase in price slows down, but that's still there. So if inflation is at 3% and then it goes down to 2, that only means that prices are going to rise 2% and no longer 3% for that period. So we shall see, and let's see what happens in the beginning of next year. But I think that we're going to get a ruling from the Supreme Court before that, and if not, everything is still in play for the fourth quarter earnings season, which is
We shall wait around and see. But having said that, now you briefly touched upon this just a few minutes back. But what is in your experience, based on your experience, what is your outlook now for sort of what's going to happen towards the end of this year and maybe if it makes sense, up to Q1 of 2026.
Well, again, there's a Supreme Court ruling on tariffs, which could change things a bit. I want to wait on that.
When is that
But
happening exactly?
I think it's in the next month or two. But
Okay.
the other
Thank you.
thing is, Trump, the Trump administration has passed, or the Republicans have passed one big beautiful bill on July 4th. That is that is a catalyst for stocks. For It's a bullish argument for stocks because there's a number of deregulating factors, tax cuts, and so forth in that bill. So that's favoring stocks, favoring equities and companies that, especially American companies. But yes. So for me, starting next year, there's going to be inevitably a correction sometime in the first quarter, and that might be a direct result of some of the uncertainty around what's next to come. For example, say, and we don't get the Supreme Court ruling in December, but it's in January. That might worry people, worry investors. But I am bullish for the first quarter, until the first quarter of 2026.
Okay.
I'm
Okay.
bullish.
Well, I guess that's something that our listeners and viewers will be happy to hear. Just, we haven't explicitly mentioned it, but
And by the way,
we tend to.
sorry to interrupt you, but when I said correction, I meant a pullback. I didn't mean a full-blown correction, but a pullback. It's likely if we don't get some resolve from the Supreme Court sooner rather than later.
Okay, okay, which you mean basically sort of stop. So for those who maybe not be aware of all the terminology, we're talking about maybe stocks going down a little bit, but just a teeny tiny bit, right? Just
Right.
maybe a few percentage points. So not to the magnitude that we saw in the past month or
No,
two
no. This
with
is this
the
is
tech
a
sector.
this was a welcome flush out because those who were not in the market, who didn't belong in the market, are no longer there. So this was
Okay.
a healthy pullback, a healthy correction that we saw in the tech sector in the last month and a half.
Okay, okay. I'd like to also then, go to my next point. Now, in our sort of investment plan, or sort of the way, the way we look at investing, we don't just focus on Wall Street, right? I mean, granted, Wall
Right.
Street, it accounts for what, about 50% of the entire um, trading that happens worldwide,
I
but
don't
we
have
also
that.
have an
I don't
outlook
have that
on.
number, but it's significant. Of course, it's
Yeah.
significant. But we, of course, you see my portfolios spread out all over the world. But I'm bullish. For example, companies like BYD and NIO, two companies that are Chinese companies, are electric vehicle manufacturers. I like them both, especially BYD.
Mhm.
NIO's got some challenges. They're resolving them, and I think it's a viable company, and I think it's got a good future. They're companies that I like all over the world. But yes, the U.S. is where I'm mainly focused myself.
Sure.
In Europe, I have Nordex, which I love very much, is a windmill manufacturer, and Alstom. It's an infrastructure play. Alstom is a French company, while Nordex is a German company. But I'd say 70% of my portfolio is in the United States.
Okay. Okay. Got it. Got it. Okay. So, what is let's say, I mean, we've talked about the tech sector, we've talked about healthcare, two sectors where obviously which would not survive without constant innovation and therefore constant injection of money for investment, sort of
That's tech.
that's tech for you, right? What about the sort of
Well,
more,
biotechnology as well, biotech.
there you go.
But I don't
Yeah,
really, I
healthcare,
don't,
biotech.
yeah, I don't really play biotech. I'm not a doctor. I'm not a pharmaceutical scientist. So I try to stay away from trying to guess which new drug is going to work for a new company or a company that's a new player with some new drug. If I have to buy something, it has to be a big conglomerate, say like Merck or Bristol Myers. I don't. I'm not going to go and put my money on biotech companies. I've tried that in the past. It didn't serve me very well. So
Yeah. Oh my
better
goodness,
go
don't tell
with
me about it. I still have vividly in my memory when it was basically a bet. I mean, I
yeah.
have
Yeah,
no
that's,
hesitant.
I've
I'm
always
not.
It's fun. I've always told you that. If you don't, if you never buy what you don't understand, and I don't understand medicine, and so I'm just if I want to buy a company that's got a big portfolio of already approved FDA approved, worldwide approved medicines and pharmaceuticals, yes, but I'm not gonna buy something that I'm not gonna put my money onto something that for which I don't know the outcome, and uh, there've been
Otherwise, you might as well just go to Las Vegas, right, and just play your money over there.
let me just give you an example. In the mid '90s, there was this company that was working on erectile dysfunction, and it was called Zonagen, and the ticker on that stock was ZONA, Zona. Um, there was so much hype over the stock, but the way the way this their drug worked is that a man would have to insert something, but they went bankrupt. And guess what? Who came right after that? Viagra with Pfizer with Viagra, and that was
Yeah.
the winning. So never put your money into something that is not well
And if I
understood.
remember that story correctly, Pfizer hadn't even set out to develop a drug for erectile dysfunction. It was a drug for some heart-related problem, right? And then they
That I
saw that
don't
there was
know.
this
I,
unintended consequence. They were like, they didn't realize. And so in the end, I seem to remember the story.
I don't
I
remember
hope
this.
not wrong, but it
Possible.
wasn't done on purpose. They weren't actively seeking to, to try and develop a drug for erectile dysfunction, but it had that consequence. So then everything got diverted towards that. But anyway, um, okay. So, well, so we got going back to the point I wanted to raise earlier. So we got tech sector, we got healthcare and biotech, all three which require a constant heavy injection of capital and investment. What is your take more on can we call them sort of the bread and butter kind of stocks, or the sort of more value stocks, whether it's, consumer goods or I don't know. I mean, consumer goods
Yeah,
is a big
the
part,
stables
right?
are not really doing what I expected them to do. Like I said, perhaps a factor is some of the tariffs. But United Natural Foods, for example, is a company that I like. It's been doing quite well. They source most of their food from the United States, most of the ingredients and the stuff that they sell to Whole Foods. Um, but I had Danone in my portfolio up until recently, and then Unilever. But Danone did quite well. Okay, Unilever reacted, but then after their numbers a couple of months ago, they're not really participating in the market just like everybody else is, like the healthcare sector is. But again, there are cycles in each sector, and usually when you see a defensive stance, and you see all those sectors participate in the same manner. But no, healthcare stood out. Healthcare really, really stood out, and that's in the face of this one big beautiful bill that is going to cut Medicaid, Medicare, and all sorts of other incentives and subsidies rather to the American people. A lot of rural hospitals in America are going to close because of this. So I don't really know what it's the driver behind the healthcare sector's performance. I have no idea, but
Mm.
we'll see if it sticks. I mean, my hunch is that if the and I saw that on Friday. Stock was it? Yeah, Friday right after Thanksgiving. Stocks were doing great. Tech stocks were doing great, and the healthcare sector was down on Friday. So, if this reversal persists, where tech rebounds, then I see an opportunity for shorting the healthcare sector, I guess.
Okay. And how would one do that though, if they wanted to short?
Short an ETF. Don't try to short stocks that short an ETF. Make sure you do it. First of all, I don't encourage anybody to short because shorting a stock entails unlimited loss because numbers are unlimited. So if you short something at 10 and it goes to a million, you're wiped out. So if you buy something at 10 and it goes down to zero, that's all it can go down to, and so you lost 10. So shorting an ETF, it's a lot more
Very good
prudent,
point. Very good point. Yeah,
a
absolutely.
lot more prudent to short an ETF than it is to short a single stock. Don't ever do that.
I mean, we expect that we will probably have some. I mean, our audience will probably be composed of people who are quite well versed with investing, and so for whom the concepts that you have just been explaining are sort of bread and butter for them. But I think it is useful to sort of try and not assume that everybody who sits in our audience is going to be very proficient with all of this terminology and these sort of little
Now, this
uh,
channel, by the way, is we're going to try to keep things as simple as possible. We're not going to edit
yeah,
anything. We're just going to leave it as it is. Whatever flop we do, or we're new at this ourselves, but we want to make sure that anybody who joins this channel, by the way, subscribe, like, and leave a comment.
absolutely.
This will help us
That
a
was going
lot.
to be that was
Yeah,
going to be something I was going to say at the end,
yeah,
but
that'll
yes.
help. But we want to simplify things for investors, and trying to. So if we did this once every day, it would be just redundant and not useful. Uh, packaging this on a weekly basis, so you don't have to discuss the daily noise. We're medium to long term investors, and we want to keep it that way. We're not day traders. We don't. That's bull crap. And I'm sorry, but we're not even going to talk about day trading. I mean, sometimes it can happen that you have a profit and you buy and sell the same day, but it's not a strategy. Day trading is not a strategy.
Okay. Well, all very, very, very good points. Absolutely. Absolutely, Joe. Is there anything else you would like to add before
That's
maybe
it.
we kind of wrap up?
That's it.
Yeah?
We're around. Yeah, we're supposed to do 15 minutes. Where are we now? 40, almost 40 minutes. So we're good. I think.
Yeah.
Yeah, we wanted to do a short one, but I guess this is the first one was going to be the long one, and then perhaps we'll keep it a little shorter for the next
Yeah,
one.
so the idea, just so you all know, folks, the idea is that we're gonna make an effort to have one of these sessions on a weekly basis, so that on a Sunday at some point, wherever you're sitting, if you're in Europe, ideally around by 3-4 p.m., you'll be able to catch up on our view of how the week performed and our outlook. And therefore, in the US, as you're waking up and having your breakfast or brunch, if you like, we'd be happy, very happy and honored to have you listen to us. And yeah, this is our first episode. And what else can we say, Joe?
That's it. Have a great weekend, everybody. For
Absolutely.
whatever's left, it's a Sunday, so the remaining balance of your weekend, and we'll see you next week.
Take care, everyone. Bye.
Bye.